The Firm, India's only show on corporate law, tax and audit matters.
Hello and welcome to The Firm. On the show this week, why the definitions of ownership and control are deal breakers for 49% FDI in insurance. And 25 years after it was first enacted, the Benami Transactions Prohibition Act will finally get some teeth. It took almost 10 years for India to raise the FDI limit in insurance from 26% to 49%, all in an effort to bring in much-needed foreign capital and grow the sector. But new stipulations on ownership and control are proving to be deal breakers. Will 49% FDI in insurance remain a promise on paper? I went looking for some answers this week. Kotak Mahindra Bank will find out next week if it's going to be an Indian bank or a foreign bank. After twice deferring the matter, the Foreign Investment Promotion Board, or FIPB, is expected to decide on Kotak's proposal to increase its foreign investment limit from 49% to 55%. FIPB's response will determine not just whether Kotak can attract more foreign investment in the bank, but the accompanying interpretation will also decide the fate of Kotak's insurance business. Because any Indian company with 51% or more foreign shareholding is considered a foreign-owned company, and all downstream investments by a foreign-owned company are foreign investments. So, if foreign investment in Kotak Mahindra Bank crosses 51%, unless FIPB offers an exemption, the bank's 74% stake in its insurance joint venture will count as foreign. Add to that Old Mutual's 26% foreign stake, and all 100% of Kotak's insurance business will be foreign-owned. That's a clear violation of the 49% FDI limit in insurance. This method of calculating Indian and foreign ownership and control was devised in 2009. But the 2009 FDI policy put leading financial institutions like ICICI Bank, HDFC and HDFC Bank in trouble, because by then all three were majority owned by foreigners, even though their managements were and are distinctly Indian. Now, because of this majority foreign ownership, every investment made by these financial institutions was technically foreign investment, and that jeopardized their insurance businesses. So after months of confusion, the FDI policy finally exempted insurance and said that IRDA's regulations would apply instead. Now, under IRDA's 2000 regulations, foreign investment in banks and public financial institutions was exempt from such calculation. So that finally put ICICI, HDFC Bank in the clear. But all of that changed in February and March this year. The Insurance Amendment Act of March 2015 raised the FDI limit to 49% and added that an Indian insurance company must be Indian-owned and controlled. The rules released by the Finance Ministry in February define Indian control to mean that the insurance company must be controlled by an Indian company that is in turn owned and controlled by Indians. Now that rules out any Indian company, bank or financial institution that has more than 51% foreign ownership. And that means HDFC and ICICI Bank are already in violation of the 49% insurance FDI limit. Soon Kotak may suffer the same fate. And someday, listed companies like Edelweiss, Max, Future Retail and several others could be in similar trouble.
The unintended consequence of this is that all sponsors, almost all sponsors, unless they're individually owned, you take all our financial institutions, which are primarily the sponsors, the banks, their shareholdings are obviously more than 51% foreign, while the managements are completely Indian. And those foreigners have actually no bearing on the insurance business.
Right.
So technically, if you look at it, those are impacted today, and people like Kotak have actually applied for a permission, to figure out as to what the FIB's rule is. The rule as it stands today, yes, there is an issue.
The exemption, if it persists for, let's say, banks like ICICI, or even HDFC, if it falls under the public financial institution category, then shouldn't the same exemption be extended to all other Indian sponsors of insurance businesses?
Absolutely. Either they're listed or there are financial institutions who raise capital from foreigners which is non-controlling. I think the exemption, so somebody could have a private equity investment, for example.
Right.
It's as long as it is non-controlling, I think that should be a criteria for determining whether that comprises an Indian company.
But it isn't right now.
It isn't right now.
So how much of a problem is it posing in being able to sort of close the deal when the foreign investor wants to go from 26 to 49% in the insurance joint venture, but you've got this big question mark hanging over the interpretation of the Indian ownership itself?
So at the moment, the deal has slowed down because people are awaiting clarifications. However, most people are assuming, what we see within the deal world is most people are assuming that the clarification will be in the positive. It will follow the rational flow of what was there in 2009. Because otherwise, the very purpose of this 49% is beaten.
But have you, in your conversations with FIPB or IRDA, gotten the sense that this is going to be the interpretation?
With the government, no.
If Indian companies are dealing with ownership problems, their foreign counterparts have control issues. At Bajaj Allianz, the foreign partner Allianz has the sole right to appoint the CEO. It's not unusual. Many foreign insurance partners enjoy this right and a whole host of other rights, such as the right to appoint an alternate director, the right to approve or block alterations to capital, changes in articles, dividend declaration, geographical expansion, business diversifications. Individually or together, many of these rights could be interpreted as the right to control management, and hence would amount to control. Foreign control, that is. But the February rules are clear. Control of an insurance business in India must lie with Indians.
So under the old rules, there was no concept of control. It was really a cap of 26% on foreign ownership, and there was no restriction on control. So even with 26%, a foreign investor could virtually control through contractual arrangements, have majority on the board, and there was no restriction whatsoever.
Okay.
So now, while the increase has happened to 49%, the law as it got amended prescribed that the insurance company must be Indian owned and controlled.
What set of rights, in what combinations, will be construed as controlled by the foreign partner?
So, I mean, the simple one would be constitution of majority of the board. That would be controlled. Appointment of, the CEO, managing director would be controlled.
If it lies in the hands of the foreign party.
If it lies in the hands of the foreign
What
party.
if it's a joint decision?
The way we've really dialogued with IRDA and the government, it seems that would not be controlled. It's safe to say that, standard minority protection like capital increase, change in articles, should not be controlled.
Yeah.
A few things like business plan may or may not be controlled. But in the context of insurance, what we've discussed with IRDA has really been, but it's not yet in the rules, is that look, all of these rights, so long as they are not positive rights, should not be controlled.
Okay, let me try and look at it from the regulator and the government's point of view as well. Typically, either at 26% or at 49%. The quantum of shareholding does not denote control.
Right.
And therefore, there's no reason for a foreign partner to have control. So however painful this is legally to renegotiate with foreign partners, you can see this being justified from the government or the regulator point of view, saying, look, we allowed only 26% earlier, now it's only 49%. At no point are we saying you were allowed to have control.
Right.
So if you did have all these additional rights, that was an anomaly to begin with. And would you say that anomaly, in fact, was encouraged by the fact that most foreign partners were funding the Indian partners through a variety of side instruments, and therefore they wanted these rights to sort of justify the money they were putting into the business? That all stands to get corrected now.
Well, I wouldn't say it that way because, economic ownership and participation in profits versus control are two different things. So if the intent of the government was that, look, I want to restrict economic ownership as well as control, it should so be prescribed. It wasn't prescribed in the past. To say that that was always the intent was not true. All these documents were public, all these documents have been filed, so it wouldn't have been that wouldn't have been the intent.
Eventually, if many of these companies do want to go public, SEBI does not allow for differential rights amongst shareholders. So eventually, foreign partners, would have had to be prepared to give up these rights,
Right.
whether in 2 years, 5 years, or 7 years. So is this really a big problem today?
Well, those who actually go to the public markets and the foreigner is sitting with, let's say, 49% shares, and it's a diverse holding of the balance, then the foreigner may have de facto control. The question is, can they or will they all go to the public markets today? And in the interim, what does one do really? I mean, how does the foreigner exercise control?
The positive is that we have one insurance company which has actually got an approval as is for the 26% agreement.
So you're saying that in that case, which is the Bharti AXA case, which is publicly known now, they did manage to get through FIPB, they're currently at IRDA waiting the final, to overcome the final hurdle, that in that case, AXA did not have to give up any major rights to be able to get FIPB.
Whatever they had, they could retain. The question is, what did they have? And that is not within public domain. Frankly, if they had sold rights or the appointment of majority directors on the board, those would certainly not go through. But if they had rights which allowed them a discretion to comment or to recommend people, that is a different story. And the hope is that there will be a differentiation, strong differentiation done between protective rights and control rights.
Insurance is a capital-intensive business, and the rationale for increasing the insurance FDI limit to 49% was to attract much-needed foreign investment. But all this confusion over ownership and control is having the opposite effect.
Well, I'd say that today it's a deal breaker for sure because of the lack of clarity. So, I mean, I'd say that euphoria was 26 has gone up to 49, but the fine print that, look, it'll mean ceding control perhaps wasn't realized as much as now. And coupled with the problem that now you have to go one level up to see whether even the Indian promoter is Indian owned or controlled or foreign owned or controlled is complicating the problem even more.
The reason why we haven't seen a host of transactions, though people have been waiting for 8 years for 2649 to happen, is that there is lack of clarity.
Are you also seeing legal stalemates between joint venture partners, the foreign partner and the Indian partner? The reason I ask this is because over the last 10 years in India, we've seen insurance joint ventures get done with side letters, with call and put options that are not necessarily disclosed, and that may be in some ways, circumventing the RBI's policy of no assured return for foreign direct investors. Now you've got the rights issue that's playing into this. So you might have the case of, an option being triggered because of the change in law, which many shareholder agreements had embedded in them, but the ability to actualize the implementation of that auction is hurt by the lack of clarity on the rights front, the lack of clarity on how the Indian ownership is being calculated. Is that leading to legal stalemates at this point? So,
are there legal stalemates because projected time frames have been exceeded? Yes. Because Are they legal stalemates because of these two specific issues? No, not yet.
Okay.
But the fact is that what was supposed to happen 8 years back has happened 8 years later. Many insurance companies have had to do many different things to grow businesses. A lot of that has come back and impacted agreements. So interpretation of agreements are at play in a lot of cases in terms of how some of these triggers will get impacted. What will be the compensation for the domestic partner? What kind of valuation implications? Some of that is big.
Are you seeing Indian partners use this lack of clarity to their advantage?
Yes.
Insurance throws up a beautiful illustration. The Indian promoter must have at least 26%. The remaining 25% of the 51% that must be Indian can be held by diverse Indian entities, right? With no entity owning more than 10%. The foreign partner cannot have more than 49%. So technically you are in a situation where the foreign partner is the single largest shareholder at 49%, but does not have rights commensurate to that. the Indian partner may reduce his stake to 26%, sell to other Indian investors or private equity, etc., but will still have control. Isn't this absurd?
It is weird.
And
See, the whole insurance FDI opening up has actually been quite illogical in a period of time. First of all, why was there a restriction on insurance when we have complete open policies on banking? I mean, how is insurance any different? When you say that insurance secures lives of our people, banking holds their savings. So if there was no fuss in banking, why was there a fuss in insurance? And frankly, every regulation in insurance that I see it as some kind of political compromise, which is not ultimately thought through and hence leads to illogical decisions.
Well, that is the story of India's FDI policy. I'd like to end by pointing out that I spoke to 6-7 Indian insurance companies and not one agreed to an interview. They were simply too scared to publicly criticize the government or jeopardize their pending applications. And that is more worrying than vague FDI policies. Well, on that somber note, let's take a quick break on the firm. Coming up next, 25 years after it was first enacted, the Benami Transactions Prohibition Act will finally get some teeth.